Today, customer remediation costs explode. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I want to discuss the announcement that NAB has made with regard to an additional charge that they're making relating specifically to its customer remediation program. I think this is an important announcement in its own right, but it is also part of a broader thematic, and that is that pretty much all of the major players in Australia are spending massive amounts in terms of remediation programs. And this will have a knock-on effect in terms of their profitability. And they will also have to think quite hard about where they recover these costs from. Do they simply cut their dividends, or do they try to find ways to charge customers more? So let's start with the NAB announcement, because NAB said today there's an additional charge of $525 million after tax, or $749 million before tax, relating to its customer remediation program would be taken. As a result, the first half 19 cash earnings will drop by around $325 million, and earnings from discontinued operations by a further $200 million. And they said that they'd made around 360,000 payments to customers with a total value of $145 million, and that the remediation team is building from 350 to around 500 people across NAB. And they said of the first half 2019 charges, 90% relates to the wealth business, and the remainder is banking related. And in combination with provisions raised in the second half of 2018, total provisions for customer related remediation to the 31st of March 2019 is $1,102 million. In other words, $1.1 billion. The items responsible for this include compensation for consumer credit insurance, non-compliant advice to wealth customers, advisor service fees by NAB advice partnerships, which does not include any allowance for customer refunds, advisor service fees charged by NAB financial planning, and banking-related matters such as incorrect fee takes on fee-free transactions. These costs are to be held below the line, as it were, but clearly investors and potentially customers will have to pay for this litany of poor practice. And it begs the question, can the NAB behavioural norms be turned around, and at what cost? And more generally, it highlights the issues across the sector as we come up for the next round of results. As UBS put it in an excellent note today, underlying trends are likely to remain very soft and deteriorating in the banking sector. Firstly, volume growth should continue to slow as the credit squeeze continues and banks move to improve expense verification, which includes, of course, reduced reliance on the HEM benchmark. Secondly, a bounce in net interest margin is expected following mortgage repricing, but the question is how much of this is competed away or be hit by mix and switching. Will the sharp fall in the BBSW ease net interest margin pressure in the second half, or will it go the other way? Thirdly, trading income and banking fees are likely to remain under pressure. And next, will the banks provide guidance on costs following media reports? This is a clear area of upside, but will it just end up being passed through to customers? 5, there are signs of deterioration in the credit cycle too, maybe early, but the market will be watching this very closely. And 6, UBS says capital generation should be solid, but New Zealand is a material overhang. and they expect all the banks to maintain their dividends given pressure to release franking credits before a potential change in government. However, dividend cuts are increasingly likely, especially now, they say, given the New Zealand situation, remediation, and asset quality. But my question is, if you total up all of the remediation costs, which are now many billions of dollars across the banking sector, how much of that will be passed through to investors as lower dividends? And how much will be dressed up in various fees and charges and ultimately recovered from the broader customer base? I'm afraid that my view is the latter is more likely than the former. And just to give you one little tidbit, I know that a number of lenders are now starting to insist on lenders' mortgage insurance with a loan-to-value ratio of 70% or more rather than 80%. Now that's a 10% change. And of course, that means that they will be able to charge additional fees for providing lenders' mortgage insurance on mortgages for that extra 10%. And I think ahead we're going to see many other examples of fee recovery and charges being upped, but quietly, whilst all the news from the banks will be focusing on the remediation. And I still have my doubts about the bank's ability to deal with the fundamental cultural changes that are really required. And I ask whether, one, there is truly appetite amongst the board and senior executives of these large organisations to change, and two, whether they're capable of driving the quantum of change that is required to really drive outcomes that are right for their customers. I'm afraid that's still a very open question. Anyway, in the weeks ahead, we'll be looking at the bank's reporting and we'll tell you what we see. But meantime, just remember that all those additional costs have to be recovered from somewhere. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.